Hi, I'm Ken from Century 21 and thank you for viewing my Buy a Home 101 series. I hope you get lots of useful information out of this series, but I want you to please keep in mind that I'm licensed to sell real estate and considered an expert only here in sunny California. Real estate laws and customs can change from city to city, county to county, and state to state. This information is intended only as a guide. Okay, the first thing you need to understand is I am not an accountant and I am not licensed to give tax advice. I'm going to try to explain the tax deduction here and give you some examples, but you have to understand that there are a number of things that can affect your actual tax deduction, things I could never cover in this series. To get a better estimate of your actual savings, talk to an accountant or a tax professional. If you don't have a tax professional, you might consider getting one because your life is about to get a lot more complicated. Okay, here's how it works. Every month you make a payment on your mortgage, right? A small part of the payment goes to pay off your principal balance, while the bulk of it is going towards interest, at least at the beginning of your loan. All the money that you pay towards interest every year goes right off your income. It's like you never made it. This can be a pretty substantial sum, especially in places like Santa Cruz County. Now here's a very simplified example. Alright, say Mr. Homebuyer has a gross income of $98,000 a year. Forget about his personal deduction, forget about his charitable donations. We're not thinking of anything, just his gross income versus his taxes. According to the 2009 federal tax chart, an unmarried man would owe $21,167. Now let's just say he buys a house and his house payment is $2,300 a month. Now let's pretend that $300 a month goes towards principal and $2,000 goes towards interest. In a year, he'd be paying about $24,000 in interest. So he has a gross income of $98,000, but a net taxable income of only $74,000. Now he'd only owe $14,694. Now you see, for the year, he's going to pay almost $6,500 less in taxes. If you average that out for the entire year, he's saving just about $540 a month. To put it another way, instead of costing $2,300 a month, that new house is only costing him $1,760. So there's your simplified example of the tax deduction. But again, don't rely on this information. Talk to a tax professional. Remember, you only get this tax deduction on a house that you buy for your personal residence, not income property. If you have any questions on any of this, feel free to contact me via email or cell phone at any time.